a large amount of LNG is coming, I hope our industry collectively has the wisdom to make basic things right so small guys like us can focus on penetrating LNG into the retail market.
Welcome to Smarter Markets, a weekly podcast featuring the icons and entrepreneurs of technology, commodities, and finance, ranting on the inadequacies of our systems and riffing on ideas for how to solve them. Together, we examine the questions: are we facing a crisis of information or a crisis of trust? And will building smarter markets be the antidote? This episode is brought to you in part by Abax Exchange, where trading in centrally cleared, physically deliverable LNG and carbon futures contracts is now underway. Ready for smarter markets?
Welcome back to Markets in Transition on Smarter Markets. I'm Dave Greely, Chief Economist at Abax Technologies. Our guest today is He Yiyong, founder and CEO of LNG Easy. We'll be discussing how rising LNG supplies are spurring the development of retail LNG markets in China and developing countries, and how the pricing system for LNG needs to be adapted to meet the needs of these retail LNG markets. Hello, He Yiyong. Welcome back to Smarter Markets.
Thank you very much for inviting me again.
Well, it's great to have you back on the podcast. In this series, which we're calling Markets in Transition, we're diving into the forces that are reshaping our markets and exploring what we need to be doing to make sure that our markets are fit for purpose. And the rise of LNG has certainly reshaped the natural gas market from a series of isolated regional markets into an increasingly global one. And now, as LNG supplies continue to rise in the coming years, the question becomes, how will these LNG supplies reshape energy markets in developing countries around the world? Many people argue that these LNG supplies will lead to the displacement of coal from power generation, much like rising supplies of natural gas did in the United States. However, you see it differently, and maybe that's a good place to start. Why do you see it differently?
Mainly because of economics, right? So gas in the United States is $2, plus minus per MMBTU. LNG today, let's say $14, that's 7 times of that. So it's just affordability issue. What gas has done in the United States may not be able to repeat itself in developing countries due to a much higher cost structure for LNG.
And in the United States, Europe, Japan, Korea, natural gas has always been deeply connected with power generation. The Chinese market is very different. Could you describe the Chinese LNG market and how it developed for us?
Before I talk about that, maybe I just say something briefly about Japan. In the early 70s, Japan has developed Indonesia, Malaysia, and so on. And it was based on a diesel replacement model. So they logically fixed the price around about 14% of crude oil prices, because at that heat value equivalent, LNG is cheaper than oil for power generation purposes. So Japan has never had any gas. So it's always an LNG market. That makes sense. And then this model spread to Korea, Taiwan, Singapore, and so on. So now China, they have their first terminal in 2004, Dapeng terminal. I think they had a very cheap LNG from Australia. I remember it's less than 6%. So even at 6%, they brought the LNG to China. They quickly found out that it could not compete with coal. So I think Sinox and PetroChina really spent time to develop an alternative market for LNG, which I call retail market, because that means the customers are not power generation companies, not fertilizer plants, not the other producers of something. So LNG is used by consumers directly at the final point of consumption. In this sector, LNG is not competing with coal. It competes with LPG, diesel, gasoline, HFO, and so on. And that's why it has been successful, because the economics really work in China under this model.
And how big is this Chinese market?
I think, it went as big as the 30 million tons by truck. And that's kind of the only way that LNG can really penetrate all the retail customers. The Chinese pipeline gas system, the trunk line, takes 7 steps down to the smallest distribution line. And then wherever there is no pipeline gas network, they have the truck LNG. So basically, within this system, LNG is everywhere. Every customer, no matter where they are, there's a way to reach them. It become really, really big. The main customers were not really power generation companies. The main customers are industry. There are two things in industry. One is distributed power generation. In some countries, they're called captive power. And then industrial heat processes. You make furnace and boilers. And then you have the commercial sector, malls and hotels and restaurants. That's normally the domain of LPG, but they have kind of used LNG to completely phase out LPG in these commercial sectors. And then they have the transport sector, LCNG, using LNG as a source of feed gas for CNG stations. And then they have the LNG fueling stations for trucks and long-distance buses. And finally, they use LNG as a backup for a pipeline gas network for the cities. In north of China, good gas pipeline connections, but in the winter, the consumption is 5 to 7 times bigger than summer consumption. So the pipeline design is not enough to allow that kind of consumption. So they use a lot of LNG in the winter to inject. So that's kind of how the Chinese market works, which, yes, is very different from Europe and US and Japan.
And how much more room does that have to grow?
I think there's kind of probably hitting a ceiling in China. It reached 30 million tons. Now it's going to 28 million tons. The reason is really because the network connections are getting better and better. Just don't forget one thing. China does not expect high return on capital. So they're overbuilding all sorts of infrastructure. If there's a choice, they will lay pipeline, for example, which is not necessarily a model for developing countries.
And why do you think this Chinese model of the truck market, the ISO container market, is the one that will play out in other developing countries?
For two reasons, right? On demand side, I still believe there's an added reason why LNG cannot be expected to play a big role in base load power generation, because we used to have a competition for LNG in power, coal, but now renewable is appearing in the picture. So if you look at Pakistan, for example, has been such a rapid installation of rooftop solar. So cities like Karachi, they no longer had load shedding. Actually, they had surplus power now. They want to get rid of some power. I heard, for example, solar has also done similar things in South Africa. So South Africa has 160 days without load shedding because of solar. LNG used to have one competitor, which is coal. Now you have two. And the second one is carbon free. I think the logic of why LNG is successful in China is even more pronounced in developing countries. So that's one thing. The other thing is really all developing countries use a lot of liquid fuel. Most people don't realize how expensive liquid fuel is in most of these countries. So our calculation after market survey around the world would be something like LPG 17, 18% of Brent. HFO would be 22, 23% of Brent. Diesel is 26, 27% of Brent. Gasoline is about 30% of Brent. So you see, if you can buy bulk LNG at 10% or 11%, whatever, there's a large arbitrage between LNG and crude derivative because all these liquid fuel are. So developing countries do not have the capacity to build large-scale pipeline. China is different. They overbuild everything, high-speed train network, pipeline, electricity transmission network, blah, 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 everything. Most developing countries barely had enough to eat. They are suffering abject energy poverty. The truck model is a faster model and less capital intensive.
And you mentioned Pakistan and South Africa. Are there other countries where you see that model being adopted today?
Bangladesh is another country where very limited pipeline infrastructure. They use a lot of gas for power generation, but they're finding the pain of switching the gas to LNG because business model really rely on a national market maker. In Bangladesh, it's called Petrobangla. But Petrobangla, the loss was like $5 million out of a forex reserve of 26 billion in 2023. So you can see LNG import is a highly, highly heavy burden on the country because of the subsidies that they have to give. Just like Pakistan, Bangladesh use a lot of liquid fuel, LPG, a lot of diesel, a lot of HFO and so on. And so that's where LNG will find very good economics.
You've said in China there's a very strong willingness to build infrastructure. I was curious, what infrastructure is needed to support the growth of this use of LNG? And how rapidly is it being built, not only in China, but in these other countries?
I think this is not a bottleneck, Dave. For a simple reason, LPG is everywhere in the global south. What do you need to consume LPG? So you need a truck because there's a mothership, daughter ship. The daughter ship comes to port, offload to trucks, and then the trucks go to a consumer, which has storage facilities and or regas facilities. In the case of cryogenic LPG, also there are pressurized LPG. So you have to reduce the pressure before consumption. So the whole chain is there. And for LNG, it needs kind of almost exactly the same chain, except that the equipment has to deal with minus 160 degree. So it's a fractionally more expensive, but there are many advantages. The real obstacle is, I think, hybrid pricing model, because LNG, a large part of it is not priced according to heat equivalent. It generates all sorts of hurdles for a retail distribution model. And the way that China is resolving this is because they had large national market makers like PCL, PetroChina, Sinopec, CNOOC, and then host of second-tier guys. And they also had a lot of pipeline gas import and domestic gas production. So kind of they even out the price impact. But if you had a country where it's kind of a poor country where it's reliant on 40% of LNG import in the gas mix, that's a very, very difficult proposition. I think the bottleneck is really not infrastructure because LPG, diesel, HFO, all this would need storage at site and some kind of processing equipment at site. One more thing, you said how much it can roll down, right? So 3-6 months.
And so I wanted to get into the pricing aspect of it. Where do you see the obstacles of how pricing is done for helping these retail markets grow?
I'm looking at it from really bottom up level, right? So our hands are always dirty because we are plugged into these countries. And then we're looking up, see what should be done. And the time will come when LNG is oversupplied. Then the producers or the traders would listen to us more. At the moment, I think it's difficult because it's kind of a sort of a tug of war. For a retailer, the best pricing formula is a slope to CP. CP is contract price published by Saudi Aramco for LPG. All the buyers in the world for consumers of LPG, they can say, I'm Myanmar. So I'm $120 plus CP. I'm Vietnam. Vietnam is $90 plus CP. The Chinese terminals are, because they can allow large ships, they say, okay, we are $60. So there are trades between a big Chinese terminal in Vietnam. So China buys it for CP plus 60, and they're shipping it to Vietnam for CP plus 9. So this whole system is really logical. If we had a slope on a heat equivalent basis for LNG, we can win because LNG is an inherently better fuel. Because what all of the safety accidents you hear about the natural gas, but 99.99% is LPG. It's never LNG. It's very safe, intrinsically safe. And then, it has less emission, 15% less, has less of the non-CO2 emission and all that. But first and foremost, we are at the 400 million tons of LNG today, going to 600 million tons. LPG is a product of refining. It's a byproduct. Of course, in the United States, there is some associated gas as well. But this stock is not growing because crude production is not being invested. Let's put it that way, because Exxon recently put out a big study saying that the natural depletion rate of crude is 18% instead of 7-8%, which is normally predicted by people. So you had a shrinking crude stock, and then therefore you had a shrinking derivatives market, but you had a growing LNG pie. So it's natural that LNG should grow in more and more competitive. But at the moment, it's very funny. I'll give you an example. JKM is $13, $14. In terms of Brent slope, is 18%. But how do you compete as a LNG bunkering player with 18% slope? Because in Singapore, bunkering is priced at 115% of ultra low sulfur fuel. Okay, so that works on a slope of maybe 13%. But now suddenly in the spot market, the slope has increased to 18-19%, which means LNG as a shipping fuel is out of whack. And the ship owners look at only economics. So for them, it's a pure heat value equivalent. Once the calculation doesn't work, they go this way or that way. Very simple. So that's a perfect example. We had a lot of LNG growing, a lot more coming, but we had a very high slope spot market at the moment. So unless you are buying at 12% Brent at a long-term contract, then you can continue to offer your LNG to the LNG bunkering market. But otherwise, you can't. That's one example of why the pricing system is hindering the expansion of market share for LNG.
Yeah, and when you said you'd like to be able to price relative to like an LPG price, is that a similar logic to what you brought up with what Japan had done many years ago of saying, hey, we're trying to get people to replace diesel with gas for power generation, so we're going to price the gas coming in as LNG relative to the diesel that they're currently using. And so similar logic, you're trying to displace LPG, so price the LNG relative to that.
So heat equivalent between crude and LNG is about 16.5%, 17%. So at 14%, it gives good incentive to switch to LNG. That's the logic. And I think if we are at the verge of a new era in LNG, then the producers or the market makers here today should really think about new benchmarks. Or you can have a 100% spot market. I think the trouble now is really you had maybe 65% index to oil, and then you have 35% spot. And the spot is driven by TTF, which is the regional gas hub price. That is the difficulty. It's, of course, if you had a big book, you can trade, you benefit. But if you are a small consumer, it's not going to help you. By the time we speak, I just looked this up. We had about 180 players in LNG. That is not a liquid market, not at all. You can't increase. You would like to go to a diesel selling situation where you have thousands of buyers. And you go to LPG, maybe you had at least 300 buyers. 180 buyer is not a liquid market. And most of these players are concentrated in China, Japan, and a few certain countries. Let's say you had 30 players in China. That's one country. And then you take them out, you're down to 150 players. The market is not liquid enough today. It was designed for wholesale market, pond to pond. And I'm of the belief that pond to pond market is kind of coming to not an end, but I think it needs a new market to help it along, especially if we had to absorb all the new volumes. Then the market had to kind of go into a break bulk, smaller player mode, liquid to liquid distribution for liquid fuel replacement in the retail market. If my market view is right, pricing has to kind of change somehow.
And I wanted to ask you a little bit about some of these connections between the broader LNG market, which to a large extent was designed to kind of support LNG to a pipeline, to a power generation station, whether it was in Europe, Japan, Korea, Singapore, etc. What do you need to do to be able to allow this retail infrastructure to plug into, in some sense, this infrastructure that was built for kind of a different purpose in a way? You mentioned like mother-daughter ships, and how difficult is that to make those connections?
I think the main thing is that you need to land LNG in liquid form, because at the moment we had on-land terminals and we had FSRUs. The FSRUs would work perfect for a pipeline model. For example, Bangladesh, the FSRUs are 15 kilometers away from shore. Impossible to send LNG to shore because more than 3 kilometer pipeline, it make it almost impossible to handle with the pressure loss and all that. Dave, fundamentally, where did LNG come from? Gas is $2 in the United States. We spend 115% Henry Hub to pipe it to a liquefaction plant. And then we spend between $2.5 to $3, make it into LNG, and including the storage facility. And then we can sell it on an FOB basis. So it would take $2 to Asia, $1.5 to Europe, something like that, right? If you are going to sell it as a liquid, then you don't remove anything, because as a liquid, it has mobility premium, it has storage premium, because LNG is only the size of LNG strength 600 times compared to gas, right? So impossible to store gas, you can store LNG. So by regassing the LNG back to gas, you lost that storage premium right away upon arrival, and you lost the mobility, because then you're limited to pipeline. If the customer is 10 meters away from pipeline, tap-in pond is not cheap. The injection pond is not cheap. We were just talking to somebody in Malaysia. They're saying one injection pond is $1.25 million. One injection. So, okay, maybe 500 meters. It doesn't really matter. But the point is that it takes the mobility away from the gas when you turn it. So I think the key issue is really not the infrastructure, all this, because all the liquid fuel people are used to it. These people are used to trucking diesel around. People are used to consuming diesel. LPG is a liquid fuel. It's a product and therefore a liquid fuel. Gasoline is a liquid fuel. Just keep the LNG in liquid form. You will do really, really well. My company has a patent on the technology, which we are applying for a US patent production on that. So IP protection. So just keep it in liquid form.
And is it difficult at all to keep it in liquid form when it's going from one of these massive LNG tankers and then you're trying to get it down into these smaller units that you can put on a truck?
The Chinese on land terminals, I think, in Tianjin, for example, there's one receiving terminal, I think 250 truck loading bays. So every day they can load massive amount of trucks. And that's where the LNG importers in China make money because they get much higher margin from selling LNG than selling pipeline gas. And they've let you in a secret. The difference between LNG and pipeline gas is $4 in China. And it's much higher in Europe because TTF is what it is. But if you're driving an LNG truck in Europe, you go to a pump, you buy the LNG as a fuel for your truck, it costs more than $20. So in Europe, the gap between LNG and pipeline gas is more than $10. So now India is developing rapidly. You ask which country this model would be suitable. India is developing nicely along this way.
And if you look at these countries, including India, that could take a LNG as liquid fuel replacement for LPG, how big a market do you think that could be eventually?
Basically, in all the poor countries, what do they use? They use LPG, they use firewood, and they use animal dung. So animal dung and firewood is terrible for the environment and terrible for health. It's just kind of absolute worst stuff. I mean, you can look this up on the UN website and they try to fight it. I'm not talking only replacing LPG. Let me get back to Pakistan. They import about 1.9 million tons of LPG, but the total liquid fuel market is 20 million tons. Our calculation is 37.5 million households in Pakistan. So average, we say, they use very low figure compared to the Chinese figure. Let's say 12 to 15 MMBTU per year. That's really, really low figure. We're talking about 7 million ton market for resident. So it's not small because Pakistan now imports about 7 million tons, reduced from 9 million tons for power generation, for fertilizer plants, and for some privileged connected housing societies. But the trouble there is really when you had a country like Pakistan, Bangladesh, Thailand, gas-rich market initially, the pipeline gas is always $2. So now suddenly you are asking the customer to pay like 6 times. So what the heck? You can see the indigestion right there, right? So I turn the question, many US producers, they kind of promote a certain point of view. I always ask them, imagine US consumers need to use $12 LNG. Just imagine that.
It's hard to when we have prices that are $2 and I think in some areas it went negative recently.
What about inflation rate? What about hardship? Everything. In essence, LNG sellers asking developing countries to do is hard. China has found a third way and is successful. And therefore, I think the developing countries will, especially the big populations like India, 1.4 billion people, very congested. Bangladesh, 170 million people. Indonesia, 170 million. Vietnam, 100 million. Pakistan, 240 million. These guys should take this model because if we are lucky to replace 10%, 20% of the liquid fuel with LNG, we will have much less CO2 consumption. We will be much safer. We will take a lot of the NOx and SOx away. And financially, everybody is better off. I think that's the kind of the deal.
And I wanted to go back to a piece on the pricing with you. You talked about at the retail level, having an LPG plus kind of pricing model would work well. If you look at how the LNG on the tankers is priced, it's often indexed to a legacy benchmark like a TTF, as you mentioned, or even a Brent. How do you see the pricing system for LNG on tankers needing to evolve?
I think, again, heat equivalent is the most logical. That's how Japan started. I think the trouble is really, let's say before the spot market, it was 100% crude indexation based on value equivalent. That is a sense that's a world that makes sense. That's the classical world. But the whole world is pushing to one spot for the very reason that power generation has ceased to be a base load business for LNG to power. If you look at the European system, it's an auction system with a supply curve. So, the first to kick in is always the solars, then, the nuclear, the hydro, the wind. And then finally, you had the most expensive part of the supply curve kicking in, that's gas or slash LNG. It's a marginal based supply. Therefore, how do you sign a long-term contract? And then the other important market for Europe, which is the heating market. There's heat pumps, there's electrification, and all these things happening. So the heating part of it is becoming less important. So let's move to a developing country. The base load concept also is difficult because base load basically means that the government has to commit to a certain rate for the power, 12 cents or 10 cents or whatever. 12 cents power, basically you need $9, $10 a DES basis. And how does it work out today? It can't. So, I think, from my point of view, it seems that we are going to a spot market more and more. We need to arrive there quickly, and then we should have a genuine LNG on water pricing system. So everything is marginally cost. That is a better system than the current hybrid system. Also because current LNG price is basically driven by TTF, which is a regional gas hub price. I can't emphasize this enough. A lot of people try to confuse this subject, but I said, okay, gas is water. LNG is ice. How you make ice from water, a lot of power, different supply chain, different storage method. So don't tell me ice and water should have the same pricing. This is a very fundamental point, and maybe people try to kick the can down the road, but we had to face it because LNG, a large amount of LNG is coming. I hope our industry collectively has the wisdom to make basic things right so small guys like us can focus on penetrating LNG into the retail market. We're always lost because, we don't know what to say. I mean, I'm not a stupid guy, but I'm not a PhD on pricing. Even if I'm a PhD on pricing, I don't have the financial means to hedge all these things. Then maybe the answer is not using it. We continue to use diesel, we continue to use LPG and so on, right? It's a very, very fundamental obstacle, I would say.
I wanted to thank you for sharing your thoughts on this market with us, how it's developing, what it needs to develop further, that ability to have a more on-the-water pricing system. And I wanted to take a step back with you and say, if we get the infrastructure right, if we get the pricing system right, what do you believe the LNG market could look like in 20 to 30 years? And what do we need to be doing now to get it there?
If those two conditions are right, I think LNG will sell itself because fundamentally it's a very good fuel. It's the best fossil fuel. It beats coal in terms of emissions, 25% saving against diesel, 15% saving against LPG, no NOx and SOx. I mean, this is the main pollutants in cities. Supply and demand, I think, fundamentally, I think there will be more LNG reservoirs, crude derivatives. Everything will do its own work. It will be a towel, the energy will flow by itself. I think we have a clock system now. The reason is LNG has a point-to-point arteries. This is what we have, arteries. But you need to find veins to penetrate the body, the human body. We have all these small little connections, so blood can go into the whole body. This is what we need now. And the current pricing system actually prevents building this up. Because if you build that up and then, you always school because, your slope is out of whack or something, and then you have 6 months, you can't sell against LPG. Nobody would put money down because on a hidden value basis, we are good. Price is good. Everything is good. The intrinsic value is there. But I think seriously, pricing is a very, very, very important issue.
Thanks again to He Yiyong, founder and CEO of LNG Easy. We hope you enjoyed the episode. We'll be back next week with another episode of Markets in Transition. We hope you'll join us.
This episode was brought to you in part by Abax Exchange, where trading in centrally cleared, physically deliverable LNG and carbon futures contracts is now underway. Ready for smarter markets? Contact us at onboarding@abax.exchange. That concludes this week's episode of Smarter Markets by Abax. For episode transcripts and additional episode information, including research, editorial, and video content, please visit smartermarkets.media. Please help more people discover the podcast by leaving a review on Apple Podcast, Spotify, YouTube, or your favorite podcast platform. Smarter Markets is presented for informational and entertainment purposes only. The information presented on Smarter Markets should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Smarter Markets are those of the participants and do not necessarily reflect those of the show's hosts or producer. Smarter Markets, its hosts, guests, employees, and producer, Abax Technologies, shall not be held liable for losses resulting from investment decisions based on informational viewpoints presented on Smarter Markets. Thank you for listening, and please join us again next week.